Welcome to the debate. We are diving today into, the really challenging world of strategic planning in the gold mining industry. Specifically, we're looking at the enormous financial commitments required to actually greenlight these massive new development ventures. The source material for our discussion today, it brings into sharp focus a singular, critical question about economic forecasting. Is a single, specific market price point represented in the financial models as X dollars ounce, is that truly the necessary financial catalyst required to make these, multi-billion dollar projects economically viable?
Yeah, that question, it really cuts right to the tension, doesn't it, between the clean lines you get in financial modeling and the frankly messy realities of long-term capital deployment, especially in mining. It really asks whether we should prioritize, simplicity or a more comprehensive complexity in how we make these huge decisions.
My position is, I think, quite clear. Yes, the price 40 XOs is the critical necessary threshold. In the context of the source material's financial viability analysis, it functions as the singular, indispensable financial trigger. Without achieving that calculated market price either currently or, through credible forecasting, the entire strategic rationale for commitment, for capital acquisition, it just collapses. It is fundamentally the non-negotiable floor.
Hmm. I come at it from a slightly different perspective. While, okay, that price point is undeniably a pivotal metric for the initial assessment, relying on it as the necessary catalyst, I think it fundamentally oversimplifies the entire exercise of strategic planning. I mean, new mining projects, they require a decade, sometimes more, of development before you even see commercial production. So, treating the viability decision as just a binary switch dependent on a static price point, it ignores the dynamic levers, the internal controls that management can actually pull to reduce costs and potentially alter that very necessity.
Let's try and anchor this in finance though. We are talking about projects where the investment recovery period is measured in decades, right? The core of economic viability, especially for new projects, it really must be tied to a definitive, perhaps simple threshold that defines the boundary between viable and non-viable. Without hitting this specific figure, dollar XOZ, the venture simply cannot secure the required financing. Lenders, major equity investors, they demand a clear calculation of the required rate of return. And dollar XOZ is really the key variable that satisfies those risk models. The analytical framework presented in the source material is designed specifically to isolate this price point precisely because it provides the quickest, most powerful metric for confirming the project's financial fitness.
I just don't quite buy that the single price point is necessary in the way you define it as this sort of absolute unchanging trigger. Yes, okay, XOZ is calculated based on current cost estimates, but it's really just a snapshot in time. If a company waits solely for XOZ to appear on the screen, they might actually miss a critical strategic window. For example, maybe a competitor secures a key concession, or perhaps equipment costs suddenly spike because of global supply chain issues. True viability, I think, requires looking beyond just the immediate price trigger to much longer-term factors. Things like sustained price expectations over the 20-year mine life, projected and internal efficiencies, currency fluctuations, political stability across multiple election cycles. You know the drill. Strategic planning demands a multivariable assessment that uses XOZ more as a starting gate, perhaps, not as a permanent governing necessity.
But we have to stick to the definitional terms here. Necessary financial catalyst. That phrase isn't really about sustaining profitability 20 years down the line. It's about the prerequisite for launch. I defend that X dollars is necessary because, if your discounted cash flow analysis shows a negative net present value, a negative NPV, at any price below X dollars, then the project is, by definition, an investment failure at the moment you decide to initiate. This non-negotiable floor is what validates the whole investment to the capital markets.
Okay, that's a compelling argument regarding the financial floor. I grant you that. But necessity implies non-substitutability, right? If X dollars is reached only temporarily, say during some short-term market panic driven by geopolitical events, strategic management might still dictate, quite rationally, deferring development if the long-term forecast doesn't actually support sustained prices significantly above that calculated floor. We know the cost of capital is enormous. Initiating development only to have the price immediately fall below X dollars for the next 5 years, that destroys shareholder value. So the necessity, therefore, isn't just tied to the spot price hitting X dollars. The necessity is tied to the credibility of the forecast that the sustained price will exceed X dollars, probably by a substantial margin. And that subtle difference, I think, moves the decision away from a single price trigger and towards a more comprehensive risk assessment.
But even that comprehensive risk assessment, surely it must determine a minimum viable price. I mean, if your model, factoring in all the risk and required margins, still determines that the venture only generates the required internal rate of return, the IRR, when the gold price is above X dollars an ounce, then X dollars an ounce is, by that model's logic, the minimum necessary threshold for launch. The complexity of how you calculate the forecast doesn't really diminish the resulting necessity of the calculated price point itself. The strategic team uses all those variables, geopolitical risk, cost uncertainty, precisely to define what X dollars an ounce must be.
That's interesting, but doesn't that fundamentally misunderstand where the strategic control actually lies? You seem to assume X dollars is static once calculated, but this is a margin-based business. It's inherently dynamic. Let's maybe push back on the idea that the necessity is fixed to the price rather than the cost margin.
How so? Explain that.
Well, the core disagreement, I think, is whether the necessity rests purely on an external market factor, the price, or if it includes an internal management factor, the ability to control costs. Consider the all-in sustaining cost, the AISC, for a project. If the management team, say, secures a massive efficiency gain, maybe a radical technological innovation in ore processing that significantly lowers the energy requirement, or perhaps they renegotiate a really long-term favorable labor contract, the AISC drops. If the AISC drops, the break-even point drops. And so, the necessary price catalyst, your XOZ, instantly becomes lower.
I see the theoretical value in that. That's a perfect textbook scenario. But tell me, how often during the initial, say, 2-year feasibility window, when the XALZ threshold is initially calculated and the project needs that crucial board approval, how often do those drastic, unpredictable structural cost reductions actually materialize in a way that fundamentally alters the calculation? Rarely, I'd argue. The major variables, your AISC, your capital expenditure, they are relatively fixed during that critical approval phase. The strategic planning team, they have to operate on the known constraints. And those known constraints still mandate XALZ as the required market return to justify the risk.
But the decision to proceed is precisely a bet on the future, isn't it? It's predicated on the belief that they can achieve those internal efficiencies or somehow hedge the risk. Think about financing for a moment. If a major mining company can secure exceptionally favorable long-term credit lines, or perhaps off-take agreements, effectively hedging future price risk, they might well proceed with development even if the market price is, say, X ounce minus $100. Why would they do that? Because their ability to manage risk internally has fundamentally altered the definition of necessity for them. If the company chooses to start a phased construction, betting that the price will recover before they need to commit the highest cost capital tranches, well, they've just proven that X ounce wasn't the singular necessary catalyst. Their strategic optionality was.
I would argue, though, that optionality is perhaps a luxury afforded by massive capital reserves, not really a fundamental change in the financial necessity itself. For, let's say, a junior or mid-tier company trying to finance a major project, which, frankly, represents the majority of new ventures, they're utterly beholden to the bankable feasibility study. That study must present X ounces as the required price point to prove viability and secure the debt financing. If they try to sell the bank on optionality and potential future cost savings, they'll likely fail. The practical necessity of accessing capital in that common scenario renders X ounces necessary.
Okay. But even in that case, is the necessity the price itself, or is it the margin? Let's imagine a junior miner discovers a substantially richer ore body than they initially modeled. Their projected revenues skyrocket, right? This improves their NPV and IRR far more powerfully than a small tick up in the gold price would. If that happens, the necessary price point, the XAZ deal ZOZ, they actually need can drop significantly, allowing them to proceed even if the market price has fallen slightly since the initial calculation. So the core element of viability, I'd argue, is the project's intrinsic profitability margin, not some arbitrary external price label like X Aussie owes it.
I see why you emphasize that cost control and resource enrichment are, well, powerful variables. But let me give you a slightly different perspective, maybe centered more on clarity in the capital markets. The entire premise of this specific economic forecasting exercise, as presented, is often to isolate the one key metric, the market price, that cannot be controlled internally. All those internal variables you mentioned, cost fluctuations, financing terms, resource quality, they are factored into calculating what X on S needs to be. But once that specific hurdle price is calculated, the market price itself remains the ultimate trigger because, frankly, it simplifies the communication massively, both to investors and to the board. The strategic value of X on S is its decisiveness and its function as a clear, transparent financial commitment marker.
Clarity is indeed desirable for external communication, I won't argue that, but it can be misleading internally, can't it? Reducing the immense complexities of risk, hedging strategies, long-term cost inflation, all down into a single static trigger. It might give management a false sense of security, perhaps.
But new projects are defined by a moment of commitment, aren't they? The transition from that final feasibility study to actually breaking ground, mobilizing equipment, X dollars provides the clean, definitive breakpoint for strategic planning to move from study phase to active development. If a company relies on some constantly shifting multivariable calculus to define its viability threshold, doesn't that risk creating analysis paralysis? I mean, how does the board ever actually vote yes if the required price target changes every time they secure a slightly better financing rate?
They vote yes based on reaching a specified margin of safety, I would argue, regardless of the explicit market price at that exact moment. But let's address the commitment problem you raised. I'm not fully convinced by the clean breakpoint reasoning, because in reality, the decision to initiate a major development is very rarely a single moment. It's almost always phased. We don't just dump all the capital in one go. So the initial trigger might indeed be hitting XOZ to approve, say, the first phase of significant expenditure like detailed engineering, permitting, maybe ordering long lead equipment. However, the subsequent and far more costly phases, like the actual construction of the process plant, for example, they require mandatory reassessment based on new data, realized costs from that first phase, and current market sentiment.
Okay, but if the initial entry condition, that stage 1 funding, cannot be met because XOZ isn't reached, then the entire project never gets off the ground in the first place. So it is still necessary, even if subsequent conditions are layered on top of it later. You seem to be arguing that the complexity of the ongoing execution somehow dilutes the necessity of the launch condition. But without the necessary launch condition, the subsequent execution is, quite frankly, moot. The necessity is established right at the gate.
No. I think I argue that the necessity is contingent upon maintaining a competitive margin, which is the result of the interplay between cost structure and price. Let's imagine a scenario. XOZ was calculated today at, say, $1,800 an ounce. The price hits $1,800 and they initiate phase 1. Okay. 6 months later, the price drops to $1,700, but the company manages to secure a massive tax break from the host country, lowering their projected AISC by $150 an ounce. Their new necessary trigger price is now effectively $1,650, so they can proceed with phase 2 even though the market price is below the initial XOZ. Doesn't this prove that the original XOZ wasn't the singular necessary catalyst? The strategic ability to manage the cost base was arguably equally, if not more, necessary.
Your scenario highlights, I think, a key difference in perspective. My view is that the strategic team
calculated X dollars based on the worst-case reasonable cost scenario available at that initial time of commitment. Any subsequent cost reduction, like your tax break example, simply improves the margin of safety, but it doesn't invalidate the original X dollars as the required floor necessary to mitigate the initial enormous risk exposure. For the project to be fundable under its original structure, X dollars had to be achieved. That was the deal.
But why chain ourselves to the original structure if better, more efficient structures become available? Strategic planning must be agile, surely, insisting on a static necessity, even when the financial landscape has demonstrably changed favorably due to internal efforts. Well, that seems like poor business practice. The true necessary catalyst, I maintain, is always the optimal alignment of internal costs and external price, not one fixed market price figure set in stone months or years earlier.
Well, I think we have successfully illuminated a really profound tension here, one that probably runs through all massive long-cycle investment projects. The core disagreement really centers on whether the definitive financial catalyst required for viability is a fixed, necessary external price point, X dollars per ounce, or whether that necessity is actually dynamic, constantly shifting based on a company's success in managing its internal variables and risk exposure.
Indeed. It's really the difference between viewing financial viability as a specific moment in time, defined purely by an external benchmark, and viewing it as a continuous, adaptable state that's heavily dependent on management's ability to control internal economics and optimize that crucial cost-to-price margin.
My position remains that for those strategic teams tasked with securing the initial funding and managing the critical risk of project initiation, the financial imperative demands a clear prerequisite threshold. The analytical models, as presented in the source, dictate XOZ's is that point. It is the point at which the initial, unavoidable high-risk exposure shifts definitively into what you could call the investable category, regardless of potential future efficiencies that might or might not materialize.
And I would maintain that project initiation decisions, especially in an environment demanding decades of commitment and billions in capital, are governed by complexity, not simplicity. Necessary financial catalysts are rarely singular and static in the real world. The decision is ultimately driven by the forecast margin and the conviction that internal strategic planning can effectively manage costs, which often proves more critical than simply waiting for a specific external price tag to appear.
Right. Appreciating both the specific price requirement as, let's say, an analytical anchor point and the larger strategic context as a practical necessity, well, that probably provides a much deeper understanding of the complexity inherent in the gold industry's critical planning decisions.
Absolutely. And understanding how those internal controls can actually modify what seems like an external necessity is really key, I think, to understanding modern resource development.